If you're interested in learning all about options, but are worried that options are too complex and scared about getting confused or overwhelmed, relax. We've got you covered. In this course, we'll be teaching you all of the basics from A to Z in a very structured and easy to understand manner. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. Congratulations on finding this potentially game-changing video for your options trading. Now, let's get started helping you learn what you need to learn to start trading options the right way to grow your trading account.
Welcome to the only options trading course a beginner will ever need. The good news is that options are really actually easy to understand. All you need to learn is some simple concepts, and then a whole new world of trading is going to open up to you that you probably never knew existed. It's a world where you don't even need to pick the direction you think a stock is headed to make money. In fact, you can be outright wrong and still make money with options. And truthfully, we're in a position to know because we're one of the top proprietary trading firms in the world, and the 50 plus professional traders on our trade desk here in New York City use the strategies that we're going to be teaching you in this course all the time. So don't worry, we can break this down for you. It's not that hard. Okay, so in this course, we're going to be covering what are call options on stocks, which is how you can control hundreds and even thousands of shares of stock for a tiny fraction of what they cost. Put options on stocks, which are basically insurance against a stock going down. Then we're going to go over some surprisingly powerful things that happen when stock options expire. Then we'll go over how to make bets on entire indexes like the S&P 500 and the Dow Jones Industrial Average through buying call options on indexes or put options on indexes, and what takes place when those expire. And after that, we're going to be going over how often you can trade options and the many potential profit opportunities that you have available to you in the modern options market. After that, we're going to cover how options are priced because they're different than how stocks are priced in really interesting ways and can give rise to some startling opportunities that regularly happen. After that, we're going to get into how little cash you'll need to buy call options to control a hugely surprising number of shares of the most popular stocks. And on top of that, we'll teach you the incredible secret about selling options, an edge that most traders and investors don't even realize. After that, we're going to jump into 3 really exciting options trading strategies that you'll be able to start trading almost immediately once you open your options trading account. The covered call, the credit spread, and the iron butterfly. And trust me, you're going to get pretty excited about the profit and income potential of those 3 strategies once we explain them to you, which we're going to do in detail. Then finally, we're going to give you a step-by-step roadmap of exactly how to get started as an options trader, including how to pick an online broker, which is critical, what steps you should take to deepen your options trading knowledge, the great importance of paper trading and backtesting strategies before you trade them live, and finally, how much capital you're going to need to fund your options trading account. Okay, so let's jump in. Now, in this course, you're going to be hearing a lot about 2 key terms that are at the core of options trading: call options and put options. And while options are traded on lots of different kinds of assets, in this video, we're going to be focusing on what is meant by call and put options on stocks and call and put options on indexes. So what is a call option on a stock exactly? Well, a call option is basically a bet. The buyer of the call option is making a bet that the stock is going to go up beyond a certain price, which is known as the strike price of that option before that option expires. For that bet, he pays what's called a premium, equal to 100 times the price of the option. The call seller is the one taking that bet and receiving that premium. If the call buyer is right, he's entitled to buy 100 shares of the stock at the strike price of the option, even if the stock has moved way past that strike price. If the call buyer is wrong, the call seller pockets the premium that the buyer paid him for taking that bet. So, for example, let's say that on May 1st, XYZ stock is trading at a price of $175. Now, let's say that a trader believes that XYZ stock is going to rally. So, consistent with his opinion, he might decide to buy the 180 call, which expires on June 30th, about 2 months later, which he found by pulling up the June 30th options chain on his online broker's options trading platform, and he found that the option was trading for $3.50. But remember, he pays 100 times that price, or $350, because the call option represents the right to buy 100 shares of that stock at 180, regardless of how high it goes. If the stock rallies to, say, 190, then he can exercise his call option to buy the shares, which are worth $19,000, but he only pays $18,000, as you can see, because he had that right due to his ownership of that call option, and he can then turn around and sell them immediately for the market price of 190, receiving $19,000 for the shares, making $10 on each of his 100 shares for a gain of $1,000 on those shares. Now, deducting the $350 cost of the option from that profit nets the call buyer a net profit of $650. So the call buyer risked $350 to make $650, a reward that is a little less than twice the risk. Now, on the other hand, if the stock sells off to, say, 160, then on November 16th, the option seller, the one who took the risk, gets to simply pocket that $350 in premium that he received for the call buyer's bet. In other words, the option expires worthless. Now, why is it worthless? Well, if you have an option to buy shares at 180, but the stock's trading for 160, who's going to exercise that option when he can go out and buy them for $20 less in the open market? No one, obviously. And so the option has no value, and the option's price closes at zero on the option's expiration day. So the call buyer loses the $350 he paid for buying the option, and the call seller pockets that same $350 premium. A put option on a stock is basically the exact opposite bet. In other words, it's a bet that the stock will go down, and this bet is normally made by people who own that stock and are concerned that the stock is going to go down. The buyer of the put option pays a premium, again, equal to 100 times the price of the option to the put seller, making a bet that the stock will go down beyond the strike price of the put option. And again, the put seller is the one who's taking that bet. In the case of a put, if the put buyer is right, he gets to sell to the put seller 100 shares of that stock at the strike price of the put option, even if the stock has moved much lower than that price at any time before it expires. If, on the other hand, the put buyer is wrong and the stock expires above the strike price of the put option, the call seller just pockets the premium that the buyer paid him for taking that bet, and that's his profit. So, for example, suppose that ABC stock is trading at around 60 on August 1st. Suppose a trader owns 100 shares of ABC and wants to buy protection for those shares so that if the stock goes down below 50 before October 21st, he can sell those shares for 50 no matter how low the stock goes. In that case, then, he could buy the 50 put for $205, the $2.05 options premium times 100, representing the 100 shares. Now, if the stock closes at 42 on October 21st, then he can exercise his put and sell the shares for 50, which is 8 points more than they're worth on the open market, where they're trading for 42. So if he sold them at market, he'd only receive $4,200. But because he owns the 50 put, he gets to sell them for $50 a share, collecting $5,000. So he saved $800 on a gross basis, $8 for each of his 100 shares, receiving $5,000, where in the open market, he would have received only $4,200. Factoring in the cost of the put, that $205, the put buyer is $595 better off than had he not bought the put. On the other hand, if ABC rallies from its current price of 60 and closes at 68 on October 21st, then the put option expires worthless. Why? Well, who is going to exercise the right to sell shares at $50 when in the open market he can get them $18 higher? Obviously, that right's worthless, and so the option has no value, and it simply expires worthless, meaning the put buyer loses $205 he paid for the options and the put seller gets to pocket that same premium. When a stock option expires, your broker will take a look at the option and determine whether it has any value or not. If it's a call option and the stock price is what is referred to as out of the money, it means that the stock has closed at a price lower than the strike price of the call option, in which case the option expires with no value and just disappears from your account. But if a stock closes at a price above the call option strike price, then your broker will automatically execute that option for you, in which case for each call option you own, you'll receive 100 shares of that stock for which you'll have paid the strike price of the option for each of the shares. So for instance, if you own a 95 strike price option for a stock which closes at $98 on the day that the option expires, your broker will pay out of your account $9,500, which is $95 per share times 100 shares, to the call seller, and the call seller's broker will then deliver to your account 100 shares of the stock worth $9,800, which is the $98 per share market price times 100 shares, which means you'll show an unrealized gain of $300 in your account immediately because you spent $9,500 to own shares worth $9,800. Now, in the very fluky case where the stock closes exactly at the strike price of the stock on the day it expires, meaning the stock expired at the money, literally, then the broker will expire your option with no value because there's no purpose in exercising the call option to get shares of exactly the same value that you could buy them in the market. Stock options on puts are the exact opposite at expiration. If the stock closes above the put strike price, which is called an out-of-the-money put option, then it expires worthless because you're never going to exercise your right to sell your shares of a stock below the stock's price. So that option expires worthless. If the stock closes below the put strike in the money, then 100 shares of that stock will be sold from your account and you'll be paid the put's strike price for each of those shares, regardless of how low the stock's closing price was on the day the put option expired. And finally, just like with puts, if the stock weirdly closes exactly at the strike price of the put option, then it expires worthless because there's no point in exercising it. You'd sell your shares for exactly what they're worth in the open market, so there's no purpose in doing that. It expires worthless. It's also important to realize that stock options are generally what are called American-style options, meaning that an equity, put, or call option can be exercised at any time from the moment you buy it until it expires, which is the property that makes them American-style options. And that's an important distinction because some options are what is known as European-style options, which means that they can't be exercised until they expire. Index options, which we're just about to cover, are European-style options, as one example. In any event, if an equity option expires, your broker will automatically exercise it if it has value, which is only the case if it's in the money, as we just explained in the previous examples. All right, so now that you know how options work on stocks, let's move to how options are used to make bets on entire equity indexes, such as the S&P 500 or the Dow Jones. And similar to stock options, a call option on an index is a bet on an entire index. The buyer of the index call option is making a bet that pays off if the index price rallies above the strike price of the call. He pays a premium, again 100 times the options price, to make that bet. The call seller is the one who takes that bet. If the call buyer is right and the index on expiration day closes above the call strike price, he gets a cash payment of $100 for every point that the index exceeds the call strike price on expiration day. If he's wrong, the seller pockets the premium, just like with stock options. The buyer of an index put option gets a payment of $100 for every point the index is below the put strike price on the day it expires. If the put buyer is wrong, the seller, again, just pockets the premium. So for instance, suppose that an index's value on March 1st is 1445 and the trader becomes bullish on that index. And suppose that the 1500 call, 55 points above the current price, which expires on April 30th, 60 days later, is trading for $39.50. Well, in that case, if he wants to make a bullish bet by purchasing the 1500 call, he has to pay 100 times that, or $3,950, for which he'll receive $100 per point that the index closes above 1500 on April 30th. So if the index rallies to beyond 1500 by expiration day to say 1620, then the call option seller will have to pay the owner of that call $100 for each point above 1500. In other words, the call seller owes the buyer $12,000, and his profit is the $12,000 cash payment minus the original $3,950 cost of the option, for a net profit of $8,050. So the call buyer risked $3,950 to make $8,050 if you think about it. If, on the other hand, the index sells off to 1400, then the call option has no value. The call seller owes nothing to the call buyer because the index didn't close above 1500, and therefore the call expires worthless and the buyer loses his entire premium, while the call seller pockets the $3,950 that he was originally paid. Now, put options on indexes are the exact opposite of index call options. The index put option only pays off if the index closes below the strike price of the put option. The put buyer pays a premium, and again, the put seller receives the premium, but this time the put only pays off if the index closes below the strike price of the option on the day it expires. So let's say that an index is trading at 1425 and you're bearish. So you buy the 1350 put, which is trading for $52.25, costing you $5,225. If the index sells off to 1280, then the put buyer owes the put seller $7,000, which means that you'd make a profit of $1,775 after deducting the $5,225 put option cost. On the other hand, if the index closes above 1350 on the day it expires, that put expires worthless, and the put seller again just pockets the premium. Since you can't own an index, you can only own shares of the stocks of its components. Index options are bets that pay off in cash. In other words, index options are cash settled at expiration. If you own an in-the-money index call, your broker will automatically exercise that option by retrieving from the call seller the $100 for every point that the index closed above the call strike price. So for example, if you own a 3150 call option and an index closed at 3180, your account will automatically be credited with $3,000 because the option expired 30 points in the money, and therefore you're entitled to 30 times $100. That's $3,000 in cash for winning that bet. However, if the index closes below the call strike price on the day it expires, the option simply disappears with no value. The exact opposite is true of the index put options. If the market closes below the put option strike price, your broker will credit your account with $100 times the number of points the index closed below your put strike price. So if your put strike price is $29.50 and the index closes at $27.50, then the put pays out $2,000, as you can see from the calculation. Okay, so now moving on to how often options can be traded, you need to know that options on all stocks and indexes expire periodically, and for each expiration date, the major options exchanges offer options chains for the options of that asset expiring throughout the year. Back in the day, the major exchanges only offered options expiration once a month, which expired on the third Friday of each month. But in the first decade of this century, in the early 2000s, the major options exchanges started to offer options chains across a large swath of stocks and indexes, which expire every Friday. Eventually, certain indexes such as the SPX and NDX indexes and the exchange-traded funds based on those indexes such as SPY and QQQ introduced daily options expiration dates. So as you can see, the options market over the years has created a vastly greater number of opportunities to trade options contracts than when they first became publicly available in the 1960s, giving traders an incredible opportunity to be more targeted and granular in their trading strategies. Okay, so let's think about it. If you buy 100 shares of a stock and the stock goes up $2, it's pretty obvious that you've made $200 on that stock. But if you own a call option on a stock and the stock goes up $2, how much money do you make? Well, the true answer to that question is that you don't have enough information to answer that question. And that's because, for example, a call option's price will change differently depending upon three different factors. The first factor is the strike price of the option. You have to ask yourself, how far is the strike price of the option from the current trading price of the stock? Is it 20% above the current price? Is it 1% above the current price? Is it below the current price? Well, for a call option, the higher the strike price, the cheaper the option, which makes sense, right? Because the higher the strike price, the less likely that the stock will reach that price before the option expires. And so the market doesn't value the opportunity to buy at that price before expiration as very valuable because it's not very likely. The second factor is when it expires. How far into the future does the call option expire? Does it expire tomorrow? Does it expire in a month? Does it expire in a year? Well, with call options, the farther out in time the call option's expiration is, the higher its price will be. A later expiration allows the stock's price additional time to reach that price. And so the market values that call option more than an option at that same strike price, but less time to reach it. And the third factor is what is called volatility. How volatile is the stock's price? Is it the kind of stock that has these huge swings in price, or is it a relatively stable, boring stock? Volatile stocks have price spikes and price drops that are much more violent and frequent than low volatility stocks. A volatile stock is more likely to trigger a call option, reaching it before or at expiration, than a low volatility stock, which tends to grind up or in a slower and more orderly way. So volatile stock call options, for example, will be more valuable than their counterpart options on less volatile stocks, all other things being equal. And so all of these factors can be summarized in this table of call options pricing. The lower the strike price, the farther out in time, and the more volatile a stock is, the higher the call option will cost. And the good news is that once you understand call prices, put prices become really easy to understand. And that's because put price valuations only differ from call prices in one respect. With puts, the higher the put strike price, the higher its price. Why? Well, let's think of an example. Suppose that a stock is trading at $75 per share. Which put option would be more valuable, the 70 put or the 65 put? And the answer is obviously the 70 put, right? Because it will take a much bigger move in that stock for the put to have any value on the day it expires, because it's got to be below the put strike price for it to have any value on expiration. And that's also because the value of having a contract, a put option that gives you the right to sell your shares at 70, even if the stock goes to 40, obviously has more value than an option to sell your shares at 65 under those same circumstances. For each share, you'll have the right to sell it at a higher price for the 70 put than the 65 put, so it's obviously worth more. So other than directional movement in the price of the stock, every other aspect of the put and call pricing is actually the same. Just as with calls, the farther out in time the option expires, the more price you'll get for the call option. And just as with calls, the more volatile a stock's price is, the higher the put's price will be. And so put pricing can be summarized in a table like this, where you see that the higher the strike price, the farther out in time it is, and the more volatile the stock is, the higher the price for the put options derived from it. By now, you're probably wondering, why do traders buy stock options when they could just go ahead and buy the stock itself? I mean, after all, if you buy a call option, that's a bullish trade, right? Well, so is just buying the stock. And so by the same token, if you're bearish on a stock, you could just sell it short and make money that way. Why buy a put option and try to make money by the stock going down and the put option getting more valuable? And so a very good practice as a trader, once you become bullish or bearish on a stock, is to ask yourself, does it actually make more sense to just buy or sell the stock, or would it pay to check the options chain related to that stock to make sure that it doesn't make actually more sense to buy a call or put option on that stock instead of buying or selling short those same shares. And so here's an example. Okay, so suppose that a stock is trading at 157 and there's a 160 strike price call option that expires 30 days out, trading for $3, for which he'll pay $300, as we explained earlier. And incidentally, this is a real example of a real stock and its options. Now, if the stock never reaches 160 by the time the option expires, then the trader will lose $300, which was the risk he was taking on this trade. It can never get any worse than the $300 he paid up front. But suppose that 30 days later, the stock closed at 177 on the day the 160 call option expired. Well, let's do the math. And as you can see, if the trader were to exercise his call and buy the shares for 160, then turn right around and sell those shares for 177, he'd make $70 per share. So subtracting out the original cost of the option, you can see the net profit is $1,400, and the risk reward is awesome, risking $300 to make $1,400 in profit, or a ratio of 4.66 to 1. Now, let's compare that to the risks and rewards of buying shares of stock. To attain the equivalent of $1,400 profit as the trader achieved through the options transaction, he'd need to buy 70 shares at the original 157 price that the stock was trading at. Now, let's look at the calculation from there. And as you can see, those 70 shares will cost him this time $10,990 initially. And as the stock rises to 177, having increased $20 from where we bought it, the profit is now $20 per share, obviously, which comes to that same profit of $1,400. But in this case, the trader had to risk $10,990 to make the trade in order to make that same $1,400, which is a much, much worse risk reward of 0.127 to 1 versus close to 5 to 1 in the previous example. Now that is obviously a huge difference. Additionally, while the risk reward is substantially worse with the share purchase transaction, there is the flat out fact that the trader has to come up with $10,990 in the case of the shares, while he only needs to have $300 in cash in his account to make the call options trade. This leverage that is achieved with options contracts makes a huge difference to aspiring traders who may not have the capital available to make larger trades. You see, if you think about it, when you're trading stocks or pretty much any other asset, there are really only two very broad classifications of trades: buying stocks, which makes you long those stocks, or selling stocks, which makes you short those stocks. But with options, it gets much more interesting, because with options, you can either trade them as single options, such as buying single calls or puts, or selling single options, such as selling single calls or puts, or you can trade them in combinations with what options traders refer to as complex orders, which, despite their names, are not actually that complicated at all. Complex orders are just combinations of different options traded simultaneously in a single order. And to make this happen, you need to execute what the options market calls a complex order ticket. Now, when you buy a call on a stock, you may have realized by now that while you can effectively profit from the movement of hundreds of shares of a stock for a fraction of what would cost you to outright buy those shares, there's a kind of a cost to that. And that is that there is a hurdle to you making any money at all on the options until you have gotten past a certain hurdle, which is the cost of the option itself. So for example, let's go back to the index call option example we were discussing earlier, where the index was trading at 1445 on March 1st, and we bought a 1500 call expiring on April 30th for $39.50. So he has to pay 100 times that, or $3,950. If the index rallies and closes beyond 1500 by expiration day, say to 1590, then the option seller will have to pay the owner of that call $100 for each point above 1500. In other words, the seller owes the buyer $9,000. And so the profit on the trade is $5,050, because the $9,000 he received from the call seller exceeded the price that the call buyer paid. But let's take another case, and this is going to be very important for you to understand. Let's say that we had the exact same circumstances. The call buyer buys the 1500 call. It cost him $39.50, and thus he pays $3,950 for it. And again, we were right, and the index did indeed rally, but instead, this time the index had gone up to 1520 and then just stopped. Well, in that case, the call buyer gets paid $2,000, 20 points beyond 1500 times $100 per point. But remember, he paid $3,950 for the call. So he actually lost $1,950 by buying that call, which is the $2,000 call proceeds minus the cost of the call, the $3,950. So therefore, the absolutely crucial principle for you to remember here is that if you buy an option, you won't make any money on it until the price of the option exceeds the strike price by the amount of the premium you paid for the option. So in that last example, for the index trading at 1445 on the day you bought the option, if you buy the 1500 call for $39.50, paying $3,950, then you need the index to hit $15,039.50, which is the 1500 strike price plus the $39.50 call price in order to receive $3,950 when the call option settles. And even if it does get to $15,39.50 and you do get your payout of $39.50, all you've done is break even, as you can see from the calculation. In other words, the break even on the trade is $15,39.50, a full 39.5 points above the point where the call actually begins paying off. Now, this is a big deal. Why? Well, think about it. Since the call buyer, the one making the bet, must be right by enough to cover the premium that he paid in order to make any money on the trade at all, it obviously follows that the call seller, the one taking the bet, makes money as long as he's not wrong by more than the amount of premium the call buyer paid him, which in this example meant that at any price below $15,39.50, the call seller makes money. So ironically, you can be right about the market's direction and still lose money buying an option. When you're long an option, it's not enough to be right about the market's direction. You need to be right by enough to cover the original options premium that you paid. And so it obviously follows then that the call seller can actually be very wrong about the direction of the market and still make money. It's amazing if you think about it. To break even, the index in the example we just gave you had to rally 94.50 points from 1445 to 1539.50 for you to simply break even on buying that call, whereas the call seller makes money on any price below 1539.50. So that means that the market can rally more than 94 points and the call seller still makes money even though he took the other side of your bet that the market will go up. In other words, the call seller can be wrong by $94.49 and still make money on the trade. And so if you think about what we just said, while you do get terrific leverage from buying options, the real edge in options trading is actually selling options. Think of it this way. There are only 5 possible outcomes of, for example, an index call option trade. The index goes down a lot. The index goes down a little. The index doesn't move at all. The index rallies a little, or the index rallies a lot. That's it, right? So now let's take a look at each of those scenarios in light of buying that 1500 index call option. When the index goes down a lot, you lose the cost of the call. When the index goes down a little, you lose the cost of the call. When the index doesn't move at all, you lose the cost of the call. If the index rallies a lot to as high as 1539.49, you still lose because you didn't cover the $39.50 call cost. Only if the index rallies more than $39.50, the cost of that call, only in that one case do you win. But what about selling that same option? Well, everything gets flipped on its head, right? If the index goes down a lot, you win all the cash you received for the call. If the index goes down a little, you win all of the cash you've received for the call again. If the index doesn't move at all, you win all the cash you received for the call. If the index rallies a lot to as high as 1539.49, you still win because you received 39.50 and you only pay out 39.49. Only if the index rallies beyond 1539.50 to the point where the payout of a call exceeds the initial cash received, only in that one case do you lose money. It's incredible if you think about it. The unbelievable benefit of selling options and how it improves your win rate in a shockingly positive way. And so investors all over the world, once they learn options trading and this edge of selling options, have an amazing array of strategies available to them that can take advantage of the simple principle that you win selling options in 4 out of the only 5 cases that can happen, as we just showed you. So now you're probably wondering at this point, what are some of these popular option selling strategies? And I can tell you that a strategy called the covered call is the most popular option strategy, and that is for one simple reason. Most investors own at least some stocks in their portfolios, and while some stocks certainly do pay dividends, the fact is that the average dividend of the stocks that comprise the S&P 500 index, for example, is somewhere between 1% and 2%. Well, that's simply not enough for many investors who, while they're certainly looking for their stock portfolios to grow, also place a high priority on their investments providing an abundance of monthly cash income as well. And that's when the covered call strategy comes in, and that's because covered calls create a way to substantially increase their income from stocks. So here's how it works. Let's say that you own 100 shares of a stock XYZ, which is trading at 200, and therefore the value of your shares of XYZ is $20,000. Now, suppose that this stock pays a 1.5% dividend. Well, that comes out to $300 per year, which is right around the average of S&P 500 stocks. Now, let's say that you are somewhat bullish on the stock and you estimate that the stock could go up by, say, 20 points, 10% over the next year, but you wouldn't anticipate that it would go much higher than that. And so you pull up an options chain that expires in 1 year, and you see that the 220 call option is trading at $17. Now, if you sold that 220 call expiring in a year, then you'd receive $17 for each share that call represents. So you multiply it by 100, and as a result, you'll receive $1,700 in cash for the call. In addition, over the course of that year, you'd receive dividends totaling $300. Adding up the covered call premium that you received and the dividend you would have received results in your receiving a total of $2,000. And so as a result, just by selling the covered call, you've immediately improved by more than 500% the income that you can make through your ownership of XYZ stock, increasing that return from 1.5% to 10% simply by selling the covered call against your shares. And so if the stock closes below 220 on the day the option expires, then you just walk away with a 10% return on your shares of XYZ, and then you can go out to the next year and do it all over again. You can simply sell a call above the price the stock is trading at and earn a ton of additional income beyond the stock's dividend by selling that call above the stock's current price year after year. Now, at this point, you might be wondering why we call this strategy the covered call. What are we covering? Well, in order to understand that, we need to look at the scenario where instead of the stock closing below 220 on that day that the option expired, which is a great scenario because you earn 10% on the stock in cash income that comes right into your account. But what if instead we find that the stock did in fact close above 220, as it did in the case of this example, where the stock closed at 228.91 on the day the 220 option expired? You see, when that happens, then the call option will get exercised by the call buyer because he now has the right to buy those 100 shares from you for 220, even though they're worth 228.91. And so he's definitely going to exercise that right. And so in turn, you're obliged to sell your 100 shares of XYZ at 220 per share. And while you would not benefit from any potential gains beyond 220, you still get to keep that $1,700 in premium you received earlier, plus you'd received the dividend of $300. So in light of the fact that you wouldn't benefit from any gain beyond 220, you can see that it's important to set your covered call strike price at a share price where you'd be pretty happy to sell the shares because it's basically your price target for those shares. And doing so makes the strategy a win-win because if the shares don't get called away, you get that great income of the dividend plus the call premium. If, on the other hand, the shares do get called away, you get the capital gain from the shares as well as the call premium and the dividend. And so this potential for your shares to be called away is why this strategy is referred to as a covered call. The shares you own cover your obligation to sell the shares at 220 if the calls get exercised, which almost certainly will happen if the stock closes above 220 on the day the option expires. So remember, it's very important for you to focus on the fact that once the shares are called away, you won't own them any longer because you would have sold them at $220 per share to the call buyer. And depending upon your tax situation, you may also be required to pay a capital gains tax on those shares, which is a very important point to keep in mind if you decide to sell covered calls against shares of stock you own. And it's something you should absolutely run by your tax accountant beforehand so that you'll fully understand the tax implications of this trade. On the other hand, it's not exactly a bad thing if the stock rallies 10% and your shares get called away. In fact, if you measure your full gain for the year, it turns out that you'll have managed a 20% gain on your ownership of XYZ stock that year when you consider the covered call premium of $1,700, the dividend of $300, and the appreciation of the shares themselves, which is $2,000. While this is obviously an attractive strategy, it's important to keep in mind that if the stock rallies past your expectations, you're giving up all the upside of the strike price of the covered call while maintaining all of the downside of stock ownership if it doesn't. And so it's extremely important to set your covered call at a strike price where you'd be perfectly happy to move on from that stock at the strike price. If you set the strike price correctly, then the covered call is a kind of a win-win situation. Either you collect that great extra income on your investments or you exit those investments at prices that you considered attractive to you anyway. Plus, you keep that covered call premium whether or not your shares get called away. You've seen how powerful covered calls can be. Let's explore another really effective option strategy. And in order to do that, I'd like you to recall that earlier we discussed why the sellers of options have an edge because of the numerous ways that they can win selling options. But the downside, of course, is that if they lose, they can lose big. And in some cases, very big. So for instance, if you sell an index put option on an index, that means you think the index will go up. But if instead the index goes down and passes through your put strike price and closes far below the put strike price, then the put seller is on the hook for $100 per point below the strike price of the put. And so if the index expires way below that put strike price, the put seller takes a major bath. And so how do we prevent a loss from getting out of hand? Well, options traders have developed a strategy known as the credit spread to build a stop right into the trade's initial structure so that the loss can never get too far out of hand. Let's give you an example of how this is done. Suppose an index is trading at 32.25 and you think that the index will go up. So you decide to sell a 3,200 put on that index, a little bit below the price of the index, expiring in 30 days. And you receive a premium of $20 for that. So you'll receive $2,000 cash in your account, which is $20 times $100. If the index at least stays above 3,200 by expiration day, you'll just collect the full premium and pocket it because the put will expire worthless. Now, in this first case, you'll do nothing to protect the trade, which would be called a naked put. Now, suppose that the stock closes at 31.20 on the expiration day, 30 days later. Well, in that case, you subtract the closing price of the index from the strike price of the put option, which would result in a payout under that put of $8,000. Now, adding back the $2,000 of initial cash you received when you sold the put, the final trade loss would be $6,000, the $8,000 payout less the $2,000 credit you received for the put. But suppose that the trader instead decided to protect the trade and enter into a put credit spread. A put credit spread is when you sell a put option on a higher strike price and buy a put option on a lower strike price, both being in the same options chain. Since the put that is lower will be cheaper because it's less likely the index would drop to the level of the lower strike price than it would to drop to the higher strike price, then you'll still collect cash for the transaction, but you're going to be getting less because out of some of that cash that you receive, you're going to be using some of that to pay for a cheaper option lower down, reducing your income. So in this second case, we'll instead enter into a put credit spread, and you'll see how that provides built-in protection so the trade doesn't get out of hand. So starting with the 3200 put we sold for 20, receiving $2,000 just like we did before in the case of the naked put. But in this case, we're going to buy simultaneously a 3175 put for $11, resulting in a net cash flow of $900 in this case. Not the original $2,000 because we had to pay 11 for that 3175 put. So again, the index closes at 3120, and again, the 3200 put we sold pays out $8,000. But in this case, we own that 3175 put, so that put pays us. And as you can see from the calculation, it pays us $5,500 because the put's strike price exceeded the closing price of the index by, in this case, 55 points. So in this case, while the payout on the 3200 put remains the same, $8,000, we've got to add back the $900 we initially received for the credit spread and the $5,500 we get back for the payout from the 3175 put that we own, which brings our loss down to $1,600. And so compared to the loss of $6,000 from the naked put, the credit spread drops our loss to only $1,600. And so as you can see, credit spreads are a much safer way to create income by selling options as the risk management of the trade is built into the trade itself. As soon as the index reaches the long option, the one we bought, the long option increases in value for us point for point, negating any further loss created by the short option, effectively stopping the loss on the trade. Credit spreads can also be executed if you think an index or stock will go down. For this, you'd enter into a call credit spread, which is just the opposite of a put credit spread. In the case of a call credit spread, you would sell a call with a lower strike price and buy a call with a higher strike price in the same options chain, hoping the price in this case goes down. The lower call that you sell will be more expensive than the higher call you buy, resulting in, again, you're receiving a credit for selling the combination of short and long calls in this way. And just like with the put credit spread, the long call in this case protects you so that if the stock or index goes up, in other words, you were wrong, then the long call protects the loss on the short call from getting out of hand, just as the long put protected short put from getting out of hand in the case of the put credit spread. Now, the advantage of credit spreads is thus the built-in protection of buying the long option at the same time you buy the short option. The disadvantage is that you'll receive less net premium than simply selling the naked option because of the cost of the long option. That's the trade-off. On our trade desk, we strongly discourage naked options because they're dangerous, as we just showed you, instead opting for credit spreads, particularly overnight, where very large moves can take place, and without the build-in stop, the position becomes very dangerous. Credit spreads are a much safer way of getting the benefit of selling options, those 4 out of 5 winning scenarios we discussed earlier, without taking undue risk and risking a catastrophe. Buying and selling calls, buying and selling puts, trading covered calls, and selling credit spreads are all strategies which do best when the market goes in a certain direction. Those are known as directional options trades, which are in contrast to non-directional option strategies, which you'll be learning about in a minute. For example, if you buy a call or enter into a covered call, you'll get your best outcome if the market rallies. If you buy a put or sell a call credit spread, your best outcome is a market sell-off. And that's true of almost every other trading vehicle. Your best outcome is when the direction you've predicted is the outcome that actually takes place in the market. But with options, you have another choice. Market neutral option selling strategies, a whole category of strategies that make money regardless of whether the market rallies or sells off, as long as the market stays within a certain price range. With market neutral option selling strategies, all you need to get right is the range of prices and you'll win the trade. And with certain strategies, these price ranges can be huge and thus have an extremely high win rate, as high as 80% or higher, way above what you could reasonably expect with other trading styles. These strategies include very popular strategies such as straddles, strangles, iron condors, butterflies, calendars, and double diagonals. And so let's take a look at an example of a non-directional strategy, which is known as the iron butterfly. And to illustrate how this strategy works, let's head back to a Friday in early June, looking at an index trading at around 1880 on that day. So let's say a trader pulls up an options chain that day that expires 8 weeks out towards the end of July, and he sells one call at an 1880 strike price, right where the index is trading, for a price of $83.95, and one put at 1880 for a price of $84.40, and then simultaneously buys a call 100 points higher at 1980 for protection at a cost of $37.55, while at the same time buying a put 100 points lower at 1780 for a cost of $49.65. If he does all four of those at the same time, which any qualified options broker will do for you routinely in a single order, where you sell a call and a put at the same price, and you buy a call higher than the call you sold, and you buy a put lower than the put you sold, that entire combination of four options positions is known to options traders as an iron butterfly. And we'll show you in a minute just how powerful this strategy could be. So the first thing we'll want to do is to examine what exactly has happened here from a cash flow standpoint, so you can understand how this trade works. And so let's start with the 1880 short call. Well, we sold that one for $83.95, but remember, each point above the 1880 call pays off $100 per point, so we multiply that by 100, and so our total income from the call is $83.95. We also received $84.10 for selling the put by the same logic, and then we had to go out and buy the protective call for $37.65 and the protective put for $49.65 respectively. So if you crunch the numbers like we did here, you'll see that the total initial cash inflow from the trade is $8,115. And your broker will require $18.85 for you to put this trade on, incidentally. So just be aware of that if you do something similar. That's your worst case scenario on the trade as well. So that $81.55 in cash goes right into your account, and if your broker pays your interest on your cash balances, you'll start earning interest on that immediately, incidentally. Okay, so now let's move forward to the day that the trade expires, which is July 29th. And as you can see, the index has closed at 1885.23. Now, when the options expire, they can be given a final valuation. And so let's go ahead and do that right now. And so let's start with recalling that we received that $18,150 initially when we first entered into the trade. And so taking a look at the call, we sold at 1880. Well, that call expired below the closing price of the index. And so the way you figure out the payout on that call is that you take the index's closing price, you subtract the strike price from it, and you multiply that by 100 because it pays off $100 per point above its strike price. And so as you can see from the calculation, the result is that we'll need to pay the one we sold that call to $523. So that gets deducted from the cash we collected originally. But as you can see, the rest of the options expire with no value, worthless. And that's because the 1880 put we sold only pays off if the index closes below its strike price, which it didn't. And so that expires with no value to anyone. And of course, that's true of the 1780 put we bought also. The 1980 call we bought also expires worthless. And so if you net it all down, the only option that had any value was the 1880. And so since we sold that, we were obligated to make a payment on that one, which resulted in our being left with $7,592 of profit from the trade, which constitutes over a 400% return on a trade that lasted 8 weeks. And so I'm pretty sure you can see why people can get excited about trading iron butterflies. Now, before we move on, I wanted to make a really important point, and that's that we didn't really care if the index closed above or below the 1880 price, which was the price that the index closed on the day we entered it. For instance, let's say that the index had closed instead at 1840. Now, how would that trade have come out? Well, let's take a look at that hypothetical situation. So again, we start with the 81.15 in cash we got in, but this time the 1880 call expires worthless because it expired above the closing 1840 price. So that's a value of 0 for that one. But the short put, on the other hand, well, the index closed 40 points below its strike price. And so that will cause us to make a payout under that put, which, as you can see from the calculation, is $4,000 because we've subtracted the closing price of the index from the strike price of the put and multiplied the result by $100. And just like before, both the 1980 call and the 1780 puts both expired worthless for the same reason as in the previous example. And so in this case, the index went down by the time the trade expired, yet we made over $4,000 on the trade anyway. So as you can see, we made really good money if the index went up or if the index goes down. And that's why the iron butterfly is referred to as a non-directional trading strategy. In fact, it will make money as long as the payout under the short call or the short put is less than the original credit collected. In that case, the iron butterfly will make money regardless. So think about it. We collected 81.15. That's 81.15 times $100 per point. So as long as the index closes 81.15 points or less below 1800 or 81.15 points or less above 1800, either one, the trade makes money. So if you think about it, the downside break even is 1800 minus 81.15, as you can see from the calculation. And the upside break even is 81.15 points above 1800, as you can also see. So that means that at any price between those two break even points, 1718 on the downside and 1881.15 on the upside, you make money. And so you can now see why we refer to these as non-directional strategies, because we literally don't care if the index goes up or down. We have an opportunity to make money in either case, just as long as the index stays inside the break-even ranges of the trade in either direction. And so another way of thinking of non-directional strategies is range trades, where all you need to do is get the range right, not the direction of the index or stock. And that's why people fall in love with options income trading, honestly, because they no longer have to worry about whether they're getting the direction right. All they need to worry about is if they're getting the range right. And the cool part is that certain strategies have these huge ranges, such as iron condors, where the probability of winning can be set at north of 80%, north of 90% in some cases, because the range of iron condors can be very huge. Okay, so now that you're aware of the incredible flexibility and power of options trading, some of you might be pretty excited about getting started. And so there are a number of important steps that you should consider before you jump in. Okay, so first off, most ordinary financial institutions will neither have the expertise nor the inclination, most likely, to accept your orders to place options income strategies. And so as a result, a large industry of online brokers has emerged to serve traders who want to self-direct their trading of option strategies. Some of those brokerage platforms were specifically designed around the needs of independent retail options traders. And so here are the specific characteristics that you should be looking for at a minimum in order to hone in on which options brokerage platform would be the most suitable for you. Now, any brokerage platform that does not have a clearly laid out module in which the options chains of all major indexes and stocks are available should be immediately eliminated from consideration. Further, there should be readily available a menu of the most common option strategies, which when pulled up are automatically pre-filled with options laid out according to the details of that strategy. Iron condors, butterflies, calendars, diagonals, and vertical spreads should all be available through those menus. A picture is worth 1,000 words, as they say, and this principle is quite true of options trading strategies, which is why your online broker needs to have detailed profit graphs displaying the risk and rewards of the trade. For example, this is what a profit graph would look like for a long call, which graphically demonstrates how much profit a long 40 strike price call on a stock with a cost of 150 is worth at various closing stock prices on the day of the call option's expiration. You'll notice that because the long call cost $1.50, the call doesn't really get profitable until the stock reaches a price of $1.50 higher, which is $41.50 in this case, because otherwise the cost of the call isn't covered by the improved value of owning the option. This kind of graphic display makes it easy to see where the break even on this trade is and how much you lose at different prices or win at different prices at a glance. Otherwise, you'd have to do the math in your head for each scenario, which is obviously super tedious and hard to keep straight. Online brokers, which have profit graphs that demonstrate graphically the positions that the trader is actively trading, provide a major advantage to the trader, particularly as the positions become more complicated and the trader will need the graph to highlight the risks and rewards of the trade at a glance. Now, options prices change depending upon a number of factors, such as the price of the index or the stock that the option is related to, or the volatility of the price of that index or stock, and the amount of time until that option expires. The options Greeks measure how sensitive a particular option is to each of these factors. And as you become more experienced, you'll learn the importance of the Greeks and use them in your decision making. All you need to know at this point is that your broker must display those Greeks on your broker platform. Now, the most important Greeks are delta, which is how much the options price will move relative to how much the stock or index it's derived from will move. Vega, which is how much the options price changes based on how volatile the stock or index is. And theta, which is how much the options position gains or loses each day depending upon how far that option's expiration date is in the future. If your broker platform doesn't have column choices for the Greeks, then that broker is definitely not satisfactory for trading options. Now, most major options-oriented online brokers are more than aware of their competition and attempt to be as competitive as possible in the market. But finding the cheapest broker may not at all be in your best interest, particularly if a broker is lacking in the key platform statistics we just discussed: full order ticket menus, detailed profit graphs, and the Greeks. Having said that, the key issues to compare between brokers are as follows. Online brokers have a wide range of commission prices per options contract, but typically they're anywhere from 15 cents to $2, depending upon the size of an options account and the number of options contracts being transacted. Some options brokers do not charge anything for options contracts, in which case the broker is obtaining their revenue exclusively from what's called the order flow that they're sending to market makers or exchanges. However, you must be aware that brokers in this category might have very limited capabilities. If your options broker, as most do charge a per contract commission for each trade, and if you trade a substantial amount of transactions in a month, almost all brokers are negotiable as to their charges, and you should make sure to probe into that before making a final decision. Commissions are charged for both entering and exiting an options transaction, and thus you have to consider these round trip charges when assessing the economics of a trade. At least one major broker has decided to waive its exit fee on an options trade, only charging commissions for entering the trade initially. Some brokers charge a minimum amount for each transaction, known as the ticket charge, in addition to their commission per contract. Those brokers, as a commercial trade-off, may well charge less for commissions per options contract above the ticket charge. If your broker uses ticket charges, you must think through how many options contracts you are likely to transact at any given time and whether your effective commission rate will actually be higher when considering the ticket charge than other brokers in the market who offer higher commissions but no ticket charge. So, for instance, if your broker has a $10 ticket charge and a 20-cent commission, if you trade one options contract, your effective commission rate is $10.20 for that one options contract. You'd be a lot better off with a broker that charges even $1.50 commission rate per option in that example. Some brokers will charge a flat amount for a month and no commissions per transaction at all. Depending upon how active you plan to trade your account, this could be a very attractive option, provided that the broker has all of the other requisite capabilities. Now, there are a large number of potential fees that an online broker can charge you in addition to the base commissions that they advertise. These can include clearing fees, regulatory fees, exchange access fees, options exchange fees, and exchange membership fees. Some brokers quote you a very cheap per options contract commission rate, but then load many of those additional fees on top of that, providing for some unpleasant surprises when you've completed a transaction. Other brokers embed all fees within their stated commissions, in which case you're not charged for them explicitly. We can't emphasize enough how important it is to clarify how these various fees are handled, whether they're embedded or not, when you're considering establishing an account with an online broker. In order to be able to transact options with your online broker, you will need to have access to what the current market pricing is for each option you're trading, as well as the asset from which those options are derived, like stocks, index, currencies, or whatever. Options exchanges provide real-time market data, including quotes, order book information, and historical data for each options chain publicly available. To access this information for you, online brokers may pass on market data fees to their clients. The fee amount can vary based on the level of data required, such as basic or advanced market data packages that you'll need to choose when you first establish an account with an online options broker. So think through carefully which options you'll be trading and only ask for market data that allows you to trade those particular options and whatever other data you need to make your trading decisions. And don't get caught up in signing up for the endless amounts of available data feeds, many of which you'll rarely, if ever, need to actually use in your trading. And finally, some brokers charge fees for exercising an option known as assignment charges, while others don't. It's important to check that particular broker's policy on that subject. For instance, if a short equity call closes in the money, brokers will automatically sell your shares of the stock in question to the owner of the call at the call strike price. That's an example of the assignment of an option, and some brokers will charge for this transaction while others may not. Incidentally, most active options strategy traders use one of three platforms: Thinkorswim, Interactive Brokers, or Tastyworks, as they are all excellent in all of the minimum requirements that we detailed earlier. But this is a dynamic field, and so this list could expand over time as more and more brokers want to establish the capabilities to gain market share in this growing arena. This course, while it does cover a lot of ground, is just a start. To become a competent and successful options trader, you'll need a much more elaborate understanding of the major option strategies and their capital and margin requirements. You'll also need to learn the critical skill of adjusting and modifying positions once you've entered them, and the importance of the options Greeks and other very important topics. Without taking a comprehensive course in the fundamentals of options trading, there's a pretty high probability that you'll inadvertently put yourself into dangerous trading situations with no firm understanding of the risks of the positions you've entered, and that's a recipe for disaster. It's also our experience that traders need to experiment with each of the strategies that they're interested in through the use of backtesting software that allows you to sort of simulate having traded the strategy using real historical options pricing data from the past. Backtesting gives you confidence in your strategy, helps you to understand its strengths and weaknesses, and provides you with the simulated experience of winning and losing trades and understanding the flow of each strategy. Without backtesting, you're not prepared for live trading because you haven't built the muscle memory for the strategy, which is essential to mastering any major option strategy. Most major brokers provide you for free with a paper trading account that is funded with fictitious money, paper money. So once you've backtested a strategy, then we recommend you're paper trading the strategy for sufficient length of time to get a feel for how your broker platform works as to that strategy. When you're live trading with real capital, the last thing you want is to be fumbling around learning the ins and outs of your broker platform while your trading capital is at stake. You need to be able to operate your broker platform as a second nature activity for you. Navigating the market shouldn't be complicated by the fact that you haven't mastered your broker platform. Paper trading is the best way to master your broker platform. Each major broker provides you with a paper trading account within which you can practice and build your muscle memory for how that platform works. Don't make the mistake of not taking advantage of that. Now, when you do finally begin to trade live capital in your account, trade small for a while. You're going to make mistakes. You're going to make execution errors. You're going to experience different emotions, most of which are counterproductive to successful trading. While you're working out all these issues, the last thing you want to be doing is to discourage yourself by having each mistake magnified because you unnecessarily traded too large when you're still learning and essentially in training. You must trade live capital to learn how to be a successful trader, but you don't have to trade large to get that experience. Most traders think of any losses that they experience in their initial year of trading as additional tuition, and that's a good way of looking at it. So keep your tuition costs low and trade small. Most online brokers will inquire as to your knowledge of options trading prior to granting you options trading permission, which is another important reason to acquire a solid understanding of options fundamentals before you consider trading options with your hard-earned capital. Once they've qualified you, you may only need to fund your account with as little as $5,000. We recommend to clients that they start out with at least $5,000 so that they'll have enough capital to practice all of the major option strategies. However, if you are more than minimally active, you will be subject to what are known as pattern day trading rules, which means that the broker's risk management software will think that you are day trading options, even if you're not, and will automatically limit the number of trades that you can make in any trading week unless you fund your account with $25,000 or more. So unless you plan to make a minimal number of options trades in any given week, you might want to eventually deposit $25,000 with your broker to meet that minimum pattern day trader standards. And so it's as easy as that. To get started trading options, get a solid education in the full details of options trading, choose an online broker along the lines we just suggested, backtest and paper trade the strategies that you'll be learning during the trading process, and then fund your account, minimally at first until you have attained a level of trading consistency and success that it will be prudent for you to start judiciously adding capital and building monthly income and wealth through your options trading account. Now, as a first step in that direction, if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, plus the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, plus an incredible way to make money on a stock or index even if you're outright wrong on the direction, then just click the link that should be appearing now at the top right corner of your screen. Or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.